Hello, happy Monday. Welcome to Fidelity Connects. I'm Pamela Ritchie. So enjoy the good weather while it is here. It may not erase the market's worries, but it can be an excellent moment to invest in a bull's own moment. The tantrum in April was tough for sure, but it has been a bountiful year, says our next guest, with an international trade policy that is proving to be less bad than expected for U.S. stocks, as well as the helpful tax and depreciation levers built into the One Big Beautiful Bill. The U.S. exceptionalism story rolls out new highs pretty much weekly. A continued expansion in spend for AI development provides a powerful platform for the AI trade in the year to come as well. Joining us here today to discuss what this ultimately means for investors and advisors alike is Fidelity Director of Global Macro, Jurrien Timmer. Jurrien, warm welcome to you today. Thanks for joining us.
Good morning and happy Plaid Day.
Exactly. We're back to that's right, it's plaids. It's everything to do with fall. Glad to have time with you. It has been remarkable weather, actually genuinely outside. I think a lot of people on the East Coast have experienced an elongated autumn season. And the markets themselves also. There are worries, but what do you say to those?
You know, the bull market, so we're now in the fourth year of a bull market that began in October of 2022, and it looks pretty good. I mean, there are definitely some drawbacks. The concentration risk obviously is a real thing, and it's all good when the market goes up, and if you're passively invested or actively, but in the Mag 7. But at some point, that concentration risk will go the other way. And so that is a double-edged sword. But when you look under the hood of the market, even though it is a narrow market, earnings are doing the heavy lifting. We've got 70% of the index now having reported earnings, and the bounce has been significant. The growth rate going into earnings season was expected to be 7% for the third quarter. It's now up to about 14%. The dollar estimate has gone from 67 to $71 per share. So there is some very strong earnings momentum, and that's allowing the valuation side to take a little bit of a backseat this year. As we all know, and we used to talk about it every week, in the early days of the cyclical bull market, it was all valuation all the time. Earnings actually declined very slightly in 2023. And then in 24, earnings came in, grew 11%, but valuation still amplified the returns. And now in 2025, valuations, they were up, then they were down during the tariff tantrum. Now they're up again, but they really haven't moved anywhere. They're at high levels, don't get me wrong, and that is another headwind. But they're not doing the heavy lifting at this point. It is the earnings side, and the earnings growth rate for 2025 is, which started the year at 12, dipped down to 7 in April, is now back up to 11. So the earnings story is good. It is top heavy, there's no question, but 83% of companies have beaten earnings by an average of 5%. So it isn't just 7 stocks. It is the majority of companies in the S&P and around the world. The earnings story is a global one.
I feel like we could do a historical sort of montage, actually, of you saying through 2023, through sort of early stages of 2024, valuation story, it's great. You always give us such balanced thought. But you said quite frequently, at some point, earnings will have to take the baton. And you were sort of mentioning that through the growth evaluations for all those years. And it's done exactly what you told them to do. They were listening, ultimately. It is sort of...
So I'm not always wrong.
No, you're mostly correct in a lot of the things that you've been talking about. Now, we are seeing, to sort of follow your analogy of harvesting, we are seeing some people taking some gains at these levels. I'm sort of curious what you think about that. It's always a tricky road to follow there, but we do hear headlines about that. To what extent do you think that that's what's going on, should be going on?
Well, I mean, it's behavioral economics is, says that there's a lopsided attitude towards gains and losses, right? We're much more, it's called loss aversion. And so when the gains are good, as they have been, right? The S&P is up 99% since the bull market began. And since the secular bull market began in '09, markets up almost tenfold, right? So someone would be forgiven to say, by saying, when they say, I want to harvest these returns. And actually, as you'll see for those of you watching, when my war comes out later today, it's about, making hay while the sun shines. And so we've had a very robust period now of 16 years, accentuated by this latest cyclical bull market of very, very strong returns. And we're over harvesting, we're over earning because the rates of return are well above the historical norm, right? Which is 10, 11% per year. We're more like 15% for the last, 10 plus years. So it is important to harvest those betas while we can, and that means being in. But when people look at the markets and they look at the valuations of some of the AI stories and other companies that are sort of trying to participate in that theme, even if they don't have any earnings, people starting to see kind of this market becoming more bubbly. And they remember, of course, the internet bubble, which was only 25 years ago, well, only. And so people can be forgiven for saying, you know what, maybe I should take my chips off the table. But my sense is, between the earnings power, the AI story, which is a very juicy, compelling narrative, the fact that bond yields are very well behaved right now at about 4.1%. The Fed is cutting rates. It's now what I would think of in sort of the high neutral territory. There's not a lot not to like fundamentally and technically, other than that concentration risk and the fact that valuations, at least for the cap weighted index, are in the upper percentiles of history. Now, the average stock is not at a high valuation. And actually, I almost forgot we have charts here. If we go to slide 12, you can see that the average stock is growing earnings, is trading at an 18 multiple, is now 3 years and a month into a cyclical bull market. It looks all right, and that the same is true for global stocks. The global market also is in good shape, but again, that uptrend line that you see there with the yellow shading. We all want to participate in that because that is the harvesting while the sun shines. But again, the top heaviness, which has been a benefit, right? It has driven the S&P to levels that we otherwise simply would not have seen. We do have to watch out that at some point we could be facing the other side of that knife.
I mean, the secular markets, which you've written about, they're special because they don't happen that often. They have sort of beginning and end points. You said before, we may be in the later innings. But that said, the earnings picture that we've just gotten out on the AI to what you're speaking to looks like the spending is nowhere near finished. So that will be dumped into the economy. And I mean, there's lots of reason to think that this will continue. I don't know. What do you think about that?
Yeah, and actually, let's just pull up slide 7. I should have done that earlier, which is showing the earnings. So there's obviously a relentless gold rush, if you will, for the CapEx spend to make AI the scalable thing that, supposedly it's going to be. And, you look at the numbers, right? Like the Amazons, Meta, all these companies are spending 50, 75 billion, 100 billion, and it's like they can't get enough because they all need to win. And it's a race not only in the US, but around the world. By the way, this is just showing that very substantial bump in the earnings numbers during the current quarter. You worry, of course, about overinvestment, right? So this is trillions of dollars being spent just maintaining this infrastructure when it's all done could cost $1 trillion a year.
I haven't heard that before.
Yeah, and we don't really know what the killer app is going to be. Like, we all can go on ChatGPT or we can Google and that's all becoming smarter. But like, is that enough? Like, is that going to generate enough revenue to support $1 trillion of maintenance? But the believers will say this is not just about a search engine. This is about the pipes of the economy, like the technology-based economies around the world, and this is why it's a race. South Korea, China, Japan, the U.S. And you can't spend enough, but these things can sometimes end with overinvestment, especially when the narrative is hard to quantify. Like, we don't know. Like, OpenAI buys all this stuff from NVIDIA, and NVIDIA is providing the funding, but nobody knows where the revenue ultimately is going to come from. So it's a
Sure.
little bit of a leap of faith, but it's certainly an interesting story to watch unfold. And
It
we're
really
always looking for excesses, of course. But so far, that train is moving pretty fast.
It's moving pretty fast, and as you say, the concentration story is well telegraphed. For the other 493 companies that are in the S&P 500, do you? This is a bit crudely described, but to what extent can they be in buckets of AI versus non-AI? Some sort of exposure. They're smaller companies, but they're going to produce some version of a component that feeds into AI and therefore have a bit of a blast off on their earnings. Do you divide them that way? Is there a way to look at them that way?
Well, let's pull up 16, which doesn't answer your question, but it's interesting. I forget who it was, but one of the Wall Street houses estimates that almost half of the S&P is in some way or another an AI trade.
Really?
So the Mag 7 is like 36%. The top 10 stocks are 41%. So it is sort of an all AI all the time. And the thinking is that you're either involved with building the infrastructure, the pipes, whether it's a utility or a nuclear company or data centers, chips, all of that stuff, or you are going to provide the software, which again we don't know beyond sort of ChatGPT what the killer app will be, or you just benefit from the productivity gains that come from the AI boom. So you may not have anything to do with AI, but if you're a company that employs a lot of people that can be made a lot smarter through an AI agent, or they're replaced by an AI agent, then those companies would benefit. And that's part of the bigger narrative around, the fiscal impulse that we've talked about so many times. Can we grow out of the debt here in the US? And if we do, it will have to come from productivity because the labor force is not going to grow that much. And so it is part of the bigger narrative. And just bringing it back to the secular trend here in this chart, you can see, only 67% of stocks are in uptrends right now. So it's not a very robust number. And if you look at the pink kind of slope, that is the long-term trend line. And the yellow one is the current secular bull market. And so you can see how advanced those slopes are. And it's a very powerful thing. You don't want to be short this market because it is a train that's moving fast, but you are above the trend line. The secular trend is now, in my opinion, 16 years old, and the typical one lasts about 18 or so. And so you do start to worry about what comes after this very robust period of plentiful harvest, and will we have a period down the road where the beta becomes less robust, and then we have to get more alpha. So, the market doesn't go up 20% every year all the time because the rate of change is more like 10. And so that's something I think about. And for a typical investor who has, let's say, passive exposure, we want to make sure they understand that the passive exposure is benefiting right now from this concentration, but that can go the other way at some point as well.
Yeah, and
Hopefully not soon.
you want managers who are able to pull levers to change that
Yeah.
up
Yeah,
significantly.
or have a global diversification. Actually, I'll show you this chart 20, which I find interesting, not just because it's my chart, but because it tells a story.
Yeah.
If you look at non-US equities, so the MSCI EFA, which is non-US developed, that's a very nice uptrend, very broad participation. 75% of the stocks are going up. The earnings are good, the payouts are good, the valuations are cheap. But if you look at that pink line and the blue line, that's the relative performance against the S&P. And the blue line is against the S&P cap weighted, which of course is how everyone would measure it. But the pink line is against the equal weight, and it shows you that the global stocks are outperforming the average stock in the US. And that's important because if the concentration risk ever turns into a liability, that means that non-US equities, even if they don't go up a lot in terms of the beta, I think they are very likely to outperform very much so from an alpha perspective. And so I think for me, the barbell strategy of, okay, cap-weighted S&P, non-US developed equities is a very nice barbell strategy for navigating concentration risk in the US.
That is fascinating.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Just going back to the bull market and how long it is and how long they typically are. Historically, do they have as much technological change within one period of a bull market as we're experiencing right now? I mean, everyone wants to say it's different this time, but it does seem that we came out of financial crisis, eventually got out of that and took off properly, started the bull market, and then have had consequential change over the course of the last 2 or 3 years to change what is powering the bull market. Is that typical?
I think so. If we go to slide 18, the caveat with looking at secular trends is that there have only been a couple, right? Because they last 20 years. So there are just not that many of them. But the big ones were, of course, the roaring 1920s. I don't know that was, I guess it was technology of a kind, right? It was radio and other industrial developments. Then we had the 50s and 60s. And of course, the 60s was the space age. So we had the glamour stocks, and the 68 secular top was a little bit of a speculative bubble in the electronic stocks, right? So yes, technology or some kind of game-changing industrial or technological development is definitely part of these big booms because they raise productivity, they raise earnings, and then they become very compelling and people get involved. And then the 60s ended with a whimper. It was the late 60s. There was a little bit of a retail speculative bubble that popped, and we had the recession in 1970, and then the market came back. Then we had the Nifty 50 period, and then just inflation just ate away at valuations. And in the 90s, of course, it was more of an outright bubble where the top 50 companies in the S&P, their PE doubled from 20 to 40, while the rest of the market stayed at 20. So that was a very visible kind of period of over-enthusiasm. Let's put it that way. And actually, if we can go to slide 15 for a second, both of those periods did have something in common. They ended, of course, but if you look at the concentration in the bottom there, right? So the percentage of stocks outperforming. So in January 73, which was the top of a bull market going into the 74 bear market of 48%, only 26% outperformed at that top. Then in June of 2000, which was the top of the internet bubble, only 27% outperformed. Today, only 28% is outperforming. And again, I don't want people to get panicky that I think that this is therefore the top. But those are 3 periods of substantial concentration risk, and they happen at periods of time when it led to a leaner period. Let's put it that way.
So from that discussion, I wonder if we can just go a bit macro, because we have you with us. We'd like to do that. There is a question coming in on the ongoing U.S. debt. Ultimately, could it affect markets? I might just add into that the hearing or the announcement on IEEPA and how that court decision goes one way or the other. I mean, the tariffs have gone a long way to funding the debt issues, deficit issues in the U.S. recently. So I guess, yes, that in the background, and then a decision of IEEPA on top of it. Could you comment on market effects one way or the other, if you think there will be any?
Yeah, so we're waiting obviously on the Supreme Court. I don't think it's necessarily a market moving thing. I think that the China trade truce is much more significant.
Right.
And it just shows you that, the U.S., even though the Trump administration thinks it's holding all the cards, it's not, right? I mean, the AI boom requires rare earths, and China has them. Mm-hmm. And so they try to, bully China, and China says, not so fast. And now we have a detente. And that, of course, is bullish for the markets, because it dials back down the tariff rhetoric a little bit more. In terms of the Supreme Court, if they overrule this, the administration will just find some other obscure piece of law, emergency law, and do it then. But I think what's more important is just, this thing is now 6 months old, right? I mean, the April 2nd was about 7 months ago, and it just hasn't been as big or as bad as the markets expected. And I'm speaking on behalf of the U.S. markets. I know in Canada, you guys are really in at ground zero there. But the fears of a tariff war or a trade war have been replaced by enthusiasm from the one big beautiful bill and the kind of capex that has unleashed, and of course the AI trade. And then we have a Fed that's easing policy. We have a bond market that's very, very quiet, and the question was about the debt. And so let me pull up slide 5 here. So the bond yield is at 4.1%. I mean, the debt has not gone away. It's still happening. But at 5%, 4.5%, 5%, the bond market really starts to cause consternation in the stock market. And at 4%, it's very benign. And so I don't know why the bond vigilantes are so calm. I think the bond market is trading more off of the Fed and what it's doing and what its impact is on the forward curve. So let's say the Fed cuts a few more times. The 2-year yield would be probably at 3% if that were to happen. Then a 4% 10 yield kind of makes sense given the normal shape of the curve. My guess is also the bond market knows that Scott Bessent is a very smart, savvy Wall Street guy who will figure out a way to issue debt without unraveling the bond market. And I showed this chart because the TGA account, which is the Fed, the Treasury's cash balance at the Fed, it tends to go up and down depending on whether there's a debt ceiling cliff going on or not. And so generally, when there's a debt ceiling cliff, which there isn't right now, there's a shutdown, but not related to the debt, the Treasury will run down its cash balance and then replenish it when the debt can be issued. And so right now, Scott Bessent has replenished the TGA to $1 trillion. And I don't know why it's doing that, because there is no fiscal cliff. But maybe he is creating some powder, some dry powder, that if the bond market starts to have a reaction to the supply of treasuries, that he can just spend that trillion instead of issuing debt. So maybe he has some sort of master puppeteer kind of plan that the bond market is agreeing to. So we'll see how it happens, but it's been very quiet on the interest rate side.
He'll have an interesting memoir to write already. Scott Bassett, he clearly was all over that China trade deal, was he not?
Yes, yeah. He is the adult in the room. He's a market person, and he's the one that kind of walked, the more protectionist elements in the White House back from the edge back in April. He clearly has the president's ear, which is a good thing, and he's highly respected because he's not a crazy.
Yeah, no, it's very interesting. How long will this shutdown last? And for some reasons, the markets have been calm about it. It's more of a Washington story, I guess, ultimately, but it's obviously affecting people's lives. I'm just sort of curious your thoughts on how long this may go on.
Yeah, it's now a month old. My fear is that it will go on until something bad happens, like with an airplane, because TSA agents and air traffic controllers are only going to work for so long with no pay before they start calling in sick. And I don't know that for a fact, but you're starting to hear some stories. And as a very frequent flyer, so far I haven't had any impact, but I hope it doesn't become something like that where there's an incident at an airport and then finally they start to work. My guess is that there are other things that are more boring and legislative that will start to kind of hit deadlines that need to be resolved with a continuing resolution, and that maybe around Thanksgiving or so, finally something will be done. But so far, the market tends to look through these things, and that's exactly what they're doing right now.
Just a final thought on the markets. This is what the questions that are coming in are on. You've mentioned it a lot here, lots of questions about a bubble and so on, but maybe just to refrain how you started off with an interesting moment to make hay while the sun shines. But just your final thought for investors this week.
Yeah, we'll just pull up slide 19 real quick. So we are on bubble watch, of course, and that's the question I get from everyone. And my sense is that if this is all we're talking about, then probably it's still early, and maybe it's not a bubble at all, right? Maybe the AI boom will turn out differently from the internet boom. But the way I look at it is I look at the analog of now versus the late 90s, and of course, their spitting image. You look at that top overlay, we had long-term capital, we had a 22% decline, a very high momentum recovery, and Greenspan sprinkled 3 rate cuts on top of that. And, that sounds pretty close to what we've had over the last 6 months or so. We look at this, analogs work until they don't, so maybe this one doesn't work. But we are not anywhere close to the kind of valuations that we would need to see for, I think, many of us at Fidelity to say, holy cow. And so the earnings are doing the heavy lifting. The Mag 7 are up 4-fold since 2022. Their earnings are up 3-fold. So it is mostly an earnings based. If there's a risk, I think it's one where they just end up overinvesting without a clear payoff, right? That the AI boom rewards everyone through more time, more productivity, but that the ROI on the infrastructure doesn't materialize. But I'm not the expert on that, and we have some time before that would even pan out.
Before you say holy cow, and we're grateful for the discussion of hay. The cows are grateful for the hay. We're grateful for you who joins us, rain or shine. Jurrien Timmer, thank you for setting us up this week very much. All the very best to you.
Great. Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.